Harsha, we all know the reason why markets are volatile. Now, whether it is Russia, whether it is Russia, Ukraine, whether it is Fed, or maybe a market which was due for a correction, whatever may be the reason. The point is, how do you approach this patch of volatility?
Good morning, Nikhil. As you rightly said, I think the list of concerns is only growing. Initially, for the last couple of months, we were worried about how change in monetary policies across global banks is going to affect equity valuations and emerging market flows, etc. And now, Russia-Ukraine conflict has added to at least in terms of concerns. I would say that it's too early to say what would be the impact both in the short term and in the medium term on the markets, because we are just starting to see some impact on currency markets and financial markets. And we are just a few days into the conflict. It remains to be seen how it develops. In this scenario, I would still believe that once this conflict is behind us, monetary policies around the globe will become the central issues for the markets. So to that extent, it's very difficult to say that the volatility will die down once the conflict is kind of resolved. It may take a breather. There may be a relief rally for some time, but I would say that the change in monetary policies around the globe will be the central issue and will continue to bother markets in 2022 for quite some time.
So, are we in for like one of those years where we will get perhaps very low returns or maybe no returns?
Nikunj, that is still not our base case assumption. We are still looking at about 18 to 19% earnings growth for financial year 23. Yes, I understand if commodity prices don't cool off, there could be some cuts in this earnings growth. And also, it is not as broad-based as what we have seen in 2020 recovery or 2021. So to that extent, there could be some risks in terms of this expected earnings growth. But still, even if you account for some compression in valuations because of the higher interest rate scenario and its impact on equity valuations, we should still be looking at reasonable returns from equity. But one thing is very clear, which is already been visible in the first 1.5 months, is the fact that the volatility is going to be much higher than what we have seen from COVID lows until about March of 2021. I think volatility is definitely going to be more, and the returns are going to be moderate. Difficult to say how exactly it will pan out, but definitely more moderate than previous 2 years.
Harsha, hi, morning. Is it a fair assumption, Harsha, that up until that big domestic event, which is the Uttar Pradesh state election result plays out, one can't really call a bottom or a range on an index level, even if Ukraine and Russia would to call it truce?
I would think so. I think from a local context, the UP elections definitely will be something that market participants would be looking for in terms of what the outcome is, because that's clearly going to have some reasonable impact on 2024 elections. So I would guess next 1 or 2 weeks, we may not see a very large moves in the market, and it's going to be more choppy in a range, is what we.
So, Harsha, in the last 15 odd days, would you say that the market, even if in pockets, not at many other sector levels, has become ripe to buy into the dip? And if at all, where is it that you would recommend nibbling in or buying?
We have seen broader market correcting quite nicely, but the index has not shown that kind of volatility on the downside. Index is maybe less than 10% away from the peak. But there have been majority of stocks which have been trading at below 200-day moving average, which shows that the returns are not there in the broader market for quite some time now. So to that extent, yes, valuations have corrected, but in a situation where geopolitical events are turning on a daily basis and where there are concerns about even medium-term equity valuations because of the interest rate changes that we are likely to see, it's very difficult to call a bottom. I think you need to just look at companies and sectors where earnings steadiness is going to continue. And those are the pockets where you would probably build your positions in times of corrections. But there are also at the same time a large number of pockets where valuations are still high. So if market continues to move sideways or continues to correct, those pockets will remain under pressure in our opinion.
With the majority of the portfolio's exposure to the financial sector, I just wanted to understand what exactly your strategy is going to be there, and are you being very selective even when it comes to the banks?
Yes, we have been quite selective within financial space. In fact, we have moved our weights from non-lending businesses to lending businesses, and especially some of the large private and public sector banks. The thesis is simple. If we believe that there is going to be economic recovery in the country, then the credit growth should improve, and also asset quality issues should subside. In that scenario, a stable set of non-lending businesses, be it insurance or asset management, etc., will give you a growth which is linked to under-penetration of those products in the country, which should give you steady upside. But if the lending businesses have more leverage as compared to these non-lending businesses to how economy behaves in the times to come. So to that extent, our position has moved towards lending businesses. And even within that, we have looked at banks which are mending their asset quality issues and which are likely to do well in terms of incremental market share as we go forward. So that's been the change in stance that we have done in the last couple of quarters.
Mm-hmm. And what's the outlook when it comes to the IT space and the kind of, the kind of stocks that would make the list within this sector?
On the IT sector, we continue to remain either equal weight or slightly underweight across our portfolios. And most of this underweight is coming from mid-cap IT names where we do not have large exposure. Our belief is the valuations of the mid-cap IT names are still much higher than their historical averages, as well as they're trading at valuations which are at premium to large-cap IT names. So to that extent, in case of a market correction, there could be larger risk on mid-cap IT names. So to that extent, we have built our position only in the large-cap IT names.
I mean, there is no respite whatsoever in terms of where the market is right now. Look at the index. I mean, index per se seems to be showing signs of a crack, and there is no or very little follow-up buying. So, Harsha, what becomes the turning point for this market? Whether it is Ukraine right now or UP elections in next 8-10 days, something or the other will be there. When both these issues are sorted, we'll start talking about inflation and Fed. So something will always be there in the equity market. But my point to you is that what will be this turning point for the market? Because markets, they climb the wall of worry. That's how bull markets are born. They're born out of pessimism. So where are we in terms of that turning point, whether it is because of valuations or whether it is because of events?
You're right, Dikunj. I think if you assume that this conflict is going to be behind us in the next couple of weeks, then I think if Fed increases rates higher than what the market is expecting, if they make it more front-ended, then I think some of the overhang on the markets would be at least taken care of. So our view is if it's a very small hike initially, then market will keep thinking about the remaining hikes and the extent of hikes that would happen. But if it is a large front-ended rate hike, then to that extent, there could be some reaction in the short term. But we could also see some bottoming out in terms of valuations. May not be across markets, but at least in some select pockets. So I think sometime in the middle of March, we may see that. Let's see how Fed takes decision on that.
So Harsha, I have a very simple question. If you look at the Nifty return in last 10 years, it's about 9-10%. Just almost at double digit, which includes the recent, I'm adding up the COVID, comeback of the market. And last 10 years were not bad. They were not bad for global growth. There was no geopolitical tension. Crude was behaving itself. Interest rates were low and they kept on coming low. And in next 4-5 years, energy cost will be high. Valuations are stretched. The earnings, at least at a global level, will not be that strong. So in a perfect scenario, if you got a 10% return and when challenges are coming on the energy front, interest rates will go higher, valuations are not that great, then why should we expect good returns? Because in a best case scenario, 9-10% you've got. And when things are turning, shouldn't returns be lower?
See, as far as energy prices are concerned, yes, it's been on a high. But we have seen in the past, at least, those high prices don't last forever. The longest period where crude was above $100 for a sustained period was 2011 to 2013-14. So it was about three and a half years when crude was steadily trading about 100 to $120 per barrel. And later on, we have also seen crude correcting very, very sharply from those levels. So it's a cycle, as we all know, in the commodities. So I do not think that energy costs alone will determine the kind of earnings growth that we are expecting in our country, especially. If you look at our corporate earnings growth scenario, clearly corporate earnings are recovering and they are expected to move up even with the concerns of margins, etc., around us. In case the demand stabilizes more than what everyone is anticipating, then there could also be chances that some of the manufacturers will be able to pass on some of these costs. So from a medium to long term perspective, I do not believe that margin pressure is going to really dent the overall earnings scenario for Indian corporates. And we are expecting roughly mid-teens kind of earnings growth for Indian corporates as we go forward. And if that comes through, even if you expect some compression in equity valuations, as we discussed earlier, because of higher interest rates globally and in India as well as we go forward, even then we should get reasonable returns from equities. And that's what we think will play out.
But strategically, Harsha, would you steer clear from rate sensitives, commodity sensitives, or does that not make sense in light of your view just now?
We have not completely got out of rates. We would keep evaluating our portfolios as we go forward and take some measures if required as we go forward. But on the commodities, we do have reasonable exposure both across ferrous and non-ferrous at this point of time. We do believe that more than what has happened with the Ukraine-Russia conflict, there are long-term structural changes that have happened in the metals and other commodities. For example, ESG focus has taken a lot of prominence. So to that extent, there is increased cost for new manufacturers of commodities, and also existing manufacturers are forced to increase their spend on environmental standards and various other initiatives. So to that extent, the market is going to remain quite tight. And we have also seen China cutting down on large amount of capacity, which is also more structural in nature. So overall, the pricing strength that we are seeing in commodities is likely to continue. I'm not talking about the very short-term increase that has happened because of the conflict, but overall medium-term uptrend that we are seeing should continue. So on that basis, we do have some positions in metals and other commodities.
Tactically also, Harsha, given that we're dealing with an extremely uncertain environment, should one be looking at perhaps increasing allocation and being safer amidst large caps, or do you think in this route, I mean, up until now at least, while one has seen that the broader markets have been more battered and there's been more pain in one's mid and small cap portfolio, that perhaps may not be the case after this knee-jerk reaction plays out?
Actually, clearly the uniform moves that we saw across sectors and segments in the past 18 months or so until about October of 2021, I think is clearly behind us. As we move forward, I think we will have to really evaluate each sector, each company based on the likely earnings growth and the valuations that they are trading at. So the kind of relative comfort that we had on mid caps and small caps as a basket around the COVID lows is no longer existing. They also have moved up in terms of valuations. In many cases, mid and small caps have moved much higher than large caps in terms of valuations. So unless and until there is earnings delivery on some of these expensive stocks, whether they are from large caps or mid and small cap basket, we would continue to see choppiness in their stock performance. I think the key for investors as we go forward will be to look at and evaluate everything from a bottom-up basis and build a portfolio rather than taking more of top-down view and selecting a few sectors.
Harsha, it's been a pleasure interacting with you. Thanks very much for sharing with us your portfolio outlook as well as views on individual sectors and the market as a whole.